Okay, our next presenter here is Matt Fernley, who has been on Rockstock Channel a few times, very recently as well, about the lithium price. But he's published a lot of great articles over the last number of quarters. And one which caught our attention, which is going to be the focus of this presentation, is how to value hard rock lithium assets. And that's very appropriate given that 80% of this conference are hard rock lithium assets. So with that, Matt, why don't you go through your article and your thought process for that?
Sure. Thanks, Howard. So this is a part of a larger piece which is available on our website, which is called How to Invest in Hard Rock Lithium, and it's designed for investors really of all levels to understand how to look at these companies, how to understand how these companies trade around, but more importantly, from this point of view, how to actually value these companies. And I guess you've got to look at the stage of the company that you're looking at. So is it an exploration company, is it a development company, or is it a production company? And that's going to define how much of the way in the way of data is going to be available for the company. So for a pure exploration company, you'll find that there's only very little data available, often just resource data, measured, indicated, or inferred resources and grades. But for a later stage project where there's a scoping study or a PEA or a feasibility study, obviously there's enough information there to build a model. And then once you've got a production asset, then you can start thinking about earnings-based multiple techniques. So, if we start very early on in a company's life cycle, at an exploration stage, normally one of the ways that we value a company is just to look at the EV contained resource ton in lithium terms. And you basically get that by multiplying the total resource tonnage with grade, and then dividing that into the enterprise value or even the market capitalization. And then you can compare that across the sector. So, companies in different regions will have different valuations. Companies at different stages of their development profile will have different valuations. Companies with different grades will have different valuations. And you're looking to compare the company that you're looking at with the rest of the sector to decide whether it looks cheap or expensive compared to the rest of the sector. So that's the first sort of valuation technique. And the second valuation technique is to actually build a DCF for a project, to actually value it. And obviously you can only do that once the company has released enough information. So it's got to have at least a scoping study in play, and preferably a pre-feasibility study. And there's a number of things just to be aware of when you're looking at valuing companies in this way. Investors, particularly in the hard rock lithium space, need to look at some of the sort of key factors with regards to hard rock lithium, particularly around recovery. One of the things that we found from, unfortunately, experience is that companies will often target a recovery level in their feasibility study, which ends up not being viable actually in practice. So the recovery, the actual amount of lithium that they can get out of the asset, is something as an analyst that you've got to be very wary of. And I always go in a couple of percentage points below what the company states as the recovery is likely to be in the feasibility study. So that's something to be aware of. Operating costs and capital costs. Operating costs are relevant to the recovery. So rather, the recovery is relevant to operating costs. And again, experience has taught that most companies are a little bit too optimistic in terms of what sort of operating costs that they can return across the project. So I always bump up operating costs a little bit. And I also bump up capital costs as well. And again, experience has very much taught that management teams aren't great at estimating what capital costs are going to be. So I always put an additional contingency factor on beyond the management's contingency factor. So that's just to some of the things to be aware of. And then the other thing, when you're building a DCF, again, the ramp up. Generally, we find that the ramp up takes longer than the management team expect it to. Coming up to spec is a real issue in the lithium space because of the required purity of the product. So it generally takes much longer to ramp up. than companies expect, and that has an impact in terms of the working capital requirement, because often you'll have 3, 6 months, 12 months for the ramp up, and a company may be running at full capacity, but it may not be producing revenue. And that obviously means that you have a strong need for working capital. So just make sure you add a working capital requirement onto your CapEx when you're doing a DCF. And then the final aspect that's really important is the discount rate, and particularly in this current environment where interest rates are rising, so the cost of equity is rising and the cost of debt is rising. It's very important, particularly with companies in emerging markets, that you factor in a relevant discount rate and not just go with a sort of 6 or 7% discount rate, because unfortunately the world is changing. So, those are the key sort of aspects that you should look at when you're valuing these stocks.
Okay, great. In Canada Rocks, we have an assortment of those three types here. You have actually the agenda is in order of, at least at the beginning, expected production. So we have Sayona and Piedmont, which are, just now commissioning, and Livent and Critical Elements are both permitted and on their way to final investment decision. Allchem, somewhere in between, and then you have a number of exploration stories like Patriot, Winsome, Idaho, Green Technology Metals, and Midex. You also have some developers in Ontario, Critical Resources and Frontier Lithium, but there's a wide range of valuations, among them. On the very high end, Patriot is now like 1.5 billion market cap Australian, and they haven't even published a resource. Winsome, is $250-300 million, whereas you have Critical Elements, which is permitted. I don't know, they're like 500 million market value. So what, something that's, and then even Piedmont, and Sayona, you could start thinking about valuing them on an EV to EBITDA basis because the cash flow is so imminent. But so how do you think about, there's a wide disparity of the companies, at this conference, and what accounts for that?
Well, I think one of the most important things that you've got to look at is grade. So, generally what we find is companies with lower grade deposits tend to get slightly lower valuations. So I think that's one of the things to look at. I mean, one of the issues with the exploration stocks, again, you've got to look at the sort of mining company life cycle. And I don't have a picture of it here, but generally exploration stocks trade up very high, and then obviously they transition into the development stage and they sort of derate a little bit and then re-rate towards production. So often you get exploration stocks pushing up very high, and then as they shift more towards the development stage and there's less news flow coming out and it's more spaced out, they tend to derate a bit. Obviously, the situation with stock like Patriot, which has been releasing results of such high grade, I haven't, in the period that I've been looking at lithium, 5, 6, 7 years, ever seen drill results of that grade before. And obviously the market is struggling with how to value that stock. We obviously don't know what the maiden resource is going to be, and we don't know what the final resource is going to be, but the market is looking at the size of the drill intercepts, the depth of the drill intercepts, and the quality of the drill intercepts, and is obviously applying a view as to the quality of that deposit. And we don't really know whether the market's view is right until we see what the maiden resource is going to be, and get an idea for what the potentially the total resource could be. In some markets, particularly on the ASX, companies will sort of release an exploration target, and it gives you an idea for what management's thinking is on the total size of the resource, but it's certainly less prevalent in North American stocks.
Okay, and you said that, and we have this like Pierre Lassonde curve, which shows exploration and then going into production. That's where the stocks perform. So Sayona and Piedmont going into production are on the tail end of that. A lot of the developers are in that middle period. But when does it transition from exploration to development? Is it on the announcement of a maiden resource? Is it, a scoping study? At what point, like if you're speculating on exploration, when does that peter out and then go into that dead zone?
There's no hard and fast rule, but it's generally, in my experience, it's generally associated with a drop in news flow. When a company is exploring, they are releasing drill results very regularly. And then as they move towards development and they're focusing on sort of feasibility work, they tend to drop away the volume of drill results. And as a company moves into development, it's looking at things like sort of metallurgical test work and things like that. But that sort of news flow comes less often. So,
but there's also
that's the sort of window in which reality hits and actual cost versus feasibility start to come into focus.
Yeah. And I mean, when a company sort of scoping studies a little bit less so, but once you get the pre-feasibility study and you start thinking, actually, well, this is going to cost 400 or 500 million or whatever, and these are what the operating costs are going to be, and you think, okay, well, maybe that's a little bit more than I thought, or maybe in a few cases that's a bit less than I thought, so that's a great result or whatever. But certainly, hard reality starts to come in.
Exciting stocks in exploration phases that are coming out with high grades, long intercepts, et cetera, they can overshoot, on speculative enthusiasm. And then you're saying reality sets in, news flow, slows. It doesn't mean it's not a great asset, but it's important just to be mindful of where they are, because you can get over exuberant. And
the other thing I've noticed, Matt, is sometimes great drill results, but when they actually delineate what a pit's going to look like, sometimes that gets left behind. Some of it doesn't actually make it to the pit, so it's not as...
Yeah, and I mean, that's why, the studies are very, very important. And, as a geologist, I'm always looking at cross sections. I always look at the cross sections in the drill results. They're very, very important for understanding, what's where.
Matt, thank you very much for that great initial, tutorial. I'd encourage all viewers to go to your website and read that report. And, maybe we'll have a follow-up and go more in depth in a future video. But thanks again, Matt, and look forward to your next conversation later in our Canada Rocks conference.